Hey everyone, it's September 18th, 2015. Before I start, I want to quickly apologize if I sound a little bit stuffy. I caught a cold or a virus, I don't know which one. So if I'm not as clear as I usually am, even though I'm not really clear to begin with, I apologize. Before we jump into the charts, I want to quickly share a few comments I have about yesterday's Fed meeting. Like anyone who has an opinion, I think the Fed should have moved at least with a quarter point uh, percent move yesterday as far as the overnight lending rate or the key lending rate is concerned. In fact, I think the Fed should have moved roughly at the beginning of the year and set a trajectory or course for future rate hikes. One that is essentially established or targeted 1.5% to 2% by 2022, 2023. You have to understand that we're in a new market cycle, a new economic paradigm where the new normal as far as rates is not the what most of us are accustomed to or what we were taught in school, where essentially the Fed targets anywhere between 3 to 4% um, longer term, given current deflationary forces, weak or anemic global growths, um, tamed inflationary readings, um, little to no wage growth, and other effects, the Fed and other central banks will not be able to raise rates, or at least in the United States, the Federal Reserve won't be able to raise rates above 3% for a very, 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 very long time. When I mean very long time, I'm talking about 10 years out, if not longer. So the new normal is anywhere between 1 to 1.5%. Again, judged from a historical perspective, it's not much, and it's actually pretty low. Nevertheless, the Fed should have moved and set a course for future rate hikes. I think that would have done more as far as accommodating market expectations and truly appeasing markets than not moving and continue to use the same rhetoric as they once did. Um, Again, what does this mean? It means more of the same. It means the Fed is concerned about domestic growth in the United States and international pressures such as emerging market currency weakness, falling commodity prices, an unbalanced trade surplus or trade deficit, excuse me, and other factors. It shows that it cannot move even if it wanted, because again, the month-to-month readings in the U.S. economy are so fast-paced, even within a small range, at least on a percentage basis, they're so fast-paced that you can't really assess how the markets will respond. So in a way, people that claim the market is held hostage to markets, I think that's completely true. But that's a direct consequence of them keeping interest rates low for longer than longer than the historical average. Again, the impact the Fed fears is not so much in the economic front as it is on the financial front. A lot of banks, not just in the United States but worldwide, have essentially funded various trades, be it in corporate debt markets and public debt markets and currency markets and equity markets, through different carry trades. And a quarter or worse, a 0.5% move in the overnight lending rate, which affects other rates, it has an initial damaging impact on those trades. Many trades will have to be unwound, and that leverage trade, many banks, private clients, hedge funds, and whatnot, they've used to finance or to fund some of these trades, they're going to have to be taken off or at least pared down considerably to align to new risk profiles. I mean, what I'm discussing here is probably the most important aspect in my eyes they've considered, but it's not the only aspect. Of course, it has other implications on the financial front, but I'm just broadly speaking what the impact would have been and what it eventually will be. So that's my belief. Markets are now discounting. There's a slight possibility, less than 50%, that the Fed moves in December, and there's growing expectations of the Fed moving sometime in the first quarter of 2016. That's interesting for the reasons I'll mention in a bit. So for this week, I just want to go over a few charts. The most glaring observation I've seen just by skimming different charts is this head and shoulder formation that is forming on different indices, different sectors, and different individual stocks. Um, let's start with a name like a heavily owned and heavily weighted name like Apple. Here I've highlighted the head and shoulders formation. Now, granted, head and shoulders formation are perhaps one of the most easily or the most recognizable chart pattern out there. And it is also one that has low reliability, meaning that even once there's a confirmed breakdown, the probability that the projected target gets reached is less than 40%. So those are still some accounts you have to take into consideration. But in the case of Apple, there is this growing possibility that Apple finishes establishing this right shoulder and then breaks the neckline to essentially move as low as $76, or the height of his head and shoulders formation. I mentioned this before, but again, it's a growing concern of mine from a charting perspective. Again, head and shoulders formations are not as highly reliable as other chart patterns, but you still have to take them into account, especially when again, yeah, it's the same pattern emerging in most every other sector, and um, an index. In the case of the IBB, we're seeing uh, a similar setup form. Uh, Here, the range is essentially $60. So a break below the neckline at 340 would set the index back down to 280, which is right where it was trading last October. Not a monumental decline by any means, but still a decline to take into consideration, especially because if it happens, it will change the complete structure, and most expectations will have to vary accordingly in 2016 and even further out. So, this is the upward trend line in IBB. Again, I'm not really fond of trend lines, but for those of you that you do use them, the trend line here will coincide with a possible neckline break sometime in November and December, or until the early part of next year, which again coincidentally is when the Fed is expected to move its key lending rate. So if the Fed moves in December, catches markets or off guard, which is a possibility, it's going to coincide with this trend line break and this formation. So, most people use the excuse of the Fed hiking interest rates too early as a reason why markets decline, but technically, the markets is giving you already warning signs that it could happen. So that's something to take into consideration. So, but to be clear, I'm not predicting nor insinuating said events happening. I'm just laying out the possibility. For the SPX, it's a similar pattern. Here, the projected target would target a move down to 1680 to 1660, which in time pegs this time rate. So that's something to focus in on. Now, what could be done or what has to happen for the S&P to avoid completing this pattern and possibly fetching lower prices? Two things would need to happen. First, the S&P needs to hold 19 most we need to continue to hold, 1910 to 1920 1910 to 1920 on a weekly and monthly basis, and it would from there need to trade above 1948, which is the new pivot point. Major U.S. indices are expected to trade in and out of, at least over the next few days. Now, it also coincides, or will in time, it will come right in line with this time rate. So there's a lot of important points coming right in line in many of the major indices and currencies, which I'll show you in a bit. But for the S&P, two things will need to happen. Again, first, and I don't want to sound redundant, but 1910 to 1920 will need to hold on a closing basis, monthly and weekly, and 1948 will need to hold on a daily closing basis. A back-to-back close below 1948 does not mean markets are indefinitely bound to trade lower. They still need to break 1910 to 1920, but it does shift the odds of a move lower. The second point, perhaps more important, is that the S&P, if this 2 week bounce we've seen is legitimate at all, in other words, to test the commitment of these buyers, the market will have to set a new pattern of higher lows and higher highs, where it essentially, by default, establishes a new shorter term trend, something that has been absent so far this year, and which is part of the reason why uh, markets have had, or investors have had, such a hard time assessing market conditions, precisely because there hasn't been an established trend. So, if a new pattern of higher lows and higher highs emerges from this latest buying spree that took place over the last 2 weeks, then that also would change the balance of the trade. So, what would a higher low or higher high look like? Well, initially, a higher low would be priced in 1948 and as high as 2030, 2040, call it. The higher low would be priced in 1948, the higher high in 2040. From there, 2040 would be used as a higher low, and 2070, 2103, excuse me, would be used as a higher high. And then again, follow the same logic, 2103 the higher low, and then a new established high or a break above the current all-time high would then serve as the higher high. Again, that would change the effect of the trade by establishing a shorter-term trend and increase the probability of a possible breakout. Now, to be clear, just because in the event that this happens, the S&P does not mean the S&P is ready to break above its all-time highs. It will still have to work out the inefficiencies that were created earlier this year between 2045 and 2133 in the index, and that's going to take some time, at least 2 to 3 weeks. So that's something to take note of. To the downside, a break below, and I mentioned this before, below 1910 to 1920 would would prompt market bears to retest the August 24th, 2015 lows at 1860, 1865, and from there proceed to test the important fib retracement at 1780. A break below 1780 sends the all clear signal for move down to 1660 to 1680 on the S&P. So those are the main elements or main components or major price levels, however you want to see it, to watch for. If you look at something like the euro, here we're looking at the inverse ETF of the euro, which tracks the price performance of the euro to a dollar. In other words, you can think of it as being long dollars versus euros. It doesn't really matter if you're evaluating this particular ETF as we're doing right now, or the actual pair between dollars and euros and dollars. It's still going to come up with the same results. The important point I want to highlight is that starting the last week of September and transitioning into the first week of October, there's going to be a directional change in the euro. Whether it's going to be bullish or bearish, it's something that I've reserved for members for obvious reasons, but it's still an important date that I've decided to highlight and bring to your attention. It will have a major effect on what markets do, not only through year end, but into the beginning part of 2015. If you recall, the euro was front and center of the discussions everywhere at the beginning of the year when we got that steep depreciation in the euro and by default appreciation in the dollar. Those conversations have since abated, and most people are concentrated in oil when, in my eyes, the main focus should start to shift to the euro once more. So keep that in your radar as well. And as far as sectors, I mean, the best sector that's acting as of today, and that's not really saying much, is technology. Why do I say that? Because it's trying to recapture this previous value zone, but it hasn't done so yet. As opposed to other leading sectors before we got that major downdraft, like the IBB or even the home building sectors, the XHB, which have not only recaptured the previous value zone after that downdraft, but they've actually come as close as retesting the previous highs shortly thereafter. If you recall, a similar pattern took shape in the S&P back on October of 2014. We got that initial downdraft, we got a steep price appreciation that actually pushed the index to a new all-time high. But look what happened shortly thereafter. We essentially traded in a very narrow range, or on a 100-point range, which proved to be distribution, right? Before we got a breakdown. And even after we got this breakdown, there was no established trend. So the risk for a sector like the home building sector, which has been an outperformer, or the IBB, by recapturing these highs so quickly, is that they could enter this period where they become, or they trade in a very narrow range, at least into the foreseeable future, meaning 3 to 6 months out. If that's the case, that would have to mean that leadership, if there's going to be any, will have to come about from other sectors. You won't find it necessarily in the IBB, and that's reasonable to expect, because if you look longer term, the IBB has been an amazing run from 2012 up to the present. So it's reasonable to expect some sort of consolidation in this index. But again, that makes it increasingly harder. The point I'm trying to get at is that it's going to make it increasingly harder for other sectors to pick up the slack. And if the S&P is to trade higher, there needs to be leadership. Again, something that was absent in the prior range, and something I mentioned repeatedly as well. So whether it be consumer staples, consumer discretionary, technology, or even industrials or materials, which I don't see since the Fed didn't move, but it's a possibility as people begin to discount, or as investors begin to discount a possible Fed move by December, as early as December, or sometime in the first quarter of 2016. Those sectors could potentially move ahead of the event. So I mean, leadership could be had. It's something that certainly could take shape, but it's going to be increasingly harder to find that market leader. And until it becomes clear, you have to remain very cautious. So sector-wise, that's what I want to mention. Some a point that I think doesn't get mentioned often, but it's very, very important, is the fact that this year is the first time since 2008 that all major asset classes are down for the year. This includes equities, currencies, debt markets, but be it public or corporate. Every single market is down for the year. Even if it's less than 1%, they're down for the year. Usually, when people sell equities, they usually buy bonds. But the fact that people have sold asset classes left and right and are staying in cash shows the indecisiveness of the market, which increases the velocity of illiquidity, or the way different transactions get executed. It deepens the illiquidity in the markets, is what I'm trying to get at. And it again creates more fear by essentially keeping volatility heightened to a point where, again, you're being asked to pay a higher premium. Not necessarily, it's not as high as it was last week or 2 weeks ago, but still incredibly high to the historical average. So when you take all these factors into consideration, some of which haven't been discussed, you begin to see why markets are still in a very fragile state, despite the 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 despite price holding current levels. As of today's open, it seems as though the S&P is set to open down another 20 points. So this goes right at the heart of what I was talking about. That, to me, the better outcome would have been for the Fed to actually raise rates at the beginning of this year, because economic conditions have actually improved somewhat, and that's not saying much, but they've improved somewhat since the beginning of the year. The Fed should have rate hikes at the beginning of the year, the first through second quarter of the year, and then set out a target projected path of future rate hikes, where the second rate increase didn't have to come this year, but they could have bought themselves some time and issued a second rate hike in the first or even second quarter of 2016. I think that would help normalize trends far better. Yes, the initial reaction would have been a little bit bearish, but it's a cost that needs to be assumed and dealt with. So that's basically all I have to say about the markets. As far as something like oil, it's still forming a well-defined bottom. Is this a long-term bottom? It's too early to say. But if market bulls are to make this a meaningful bottom, right? Meaning it's bottom that something positive can come out of. Price needs to consolidate further for at least the next week or two at this upper price range. Something similar to what market bulls were trying to accomplish here, even though it obviously proved to be fruitless. If price were to retest these lows, there's a very high likelihood we see lower prices in oil. So The ideal situation for market bulls is to trade between 1424 and 16 on the USO, or between 4350 and 49 WTI. A break above 52 would confirm move up to 60. Either way, there's not much I'm saying in crude oil, but again, the longer this price holds these lows, the greater the risk is taken off the table, and that should, in a way, help equities as well. And finally, the dollar. A lot of people have turned bearish the dollar. I mean, from a charting perspective, still a massive and well-defined uptrend. I think, or I would expect the dollar to at least retest this time range once more before finding a resolution up or down. But again, the key level to watch for is still 23.79. Straight above 23.79. It still will still mean the dollar is in a bullish uptrend. And that's pretty much it. Again, we'll see what markets do. The S&P is once again back to opening or gapping up 20, 30 points in either direction, with today being a negative print at the open. Watch for the levels that were tested or broken through to the upside this week and earlier last week. If those levels are quickly taken out, I would personally step on the sidelines and see where they want to take this market, because markets shouldn't have priced or pierced through these price levels, important price levels, to the upside so quickly, and then to reverse them the other way means there is an actual buying support into that move. That's a very important point. And as far as lastly, I don't want to take much of your time, but something that let's look at the SPY here. Something that drew my attention is, just 2 weeks ago, people were talking about a September rate hike. The odds were 50-50 with a slight bias to an actual move. Going into this week, all of a sudden, the market, it's not as though economic conditions changed in a week's time, but all of a sudden, market participants discounted, or the probabilities of the Fed moving were less than 20%. So to me, all that fear that was created was a cheeky attempt to front run and private clients and most definitely retail investors to the upside. Yesterday we got that initial spike higher, and obviously institutions sold into that move. Now comes the interesting part. Will current prices and will this new value zone being created between 1920 and 1960 in the S&P, by 1980, excuse me, in the S&P hold? If institutions come in and buy at these levels, and perhaps this move has some meaning to it, there's some value to it. If it doesn't, and again, price slices through these prices as though there's no support whatsoever, I would caution and stay out. I only would get interested in a short below 1780 the S&P. That's a high probability setup. But again, that's something that needs to be seen. So, again, I want to go over the allotted time, but watch for what the S&P does. Today's quadruple witching, if I'm not mistaken, so it could lead to further volatility. And personally, I think the Fed, definitely the October meeting, they're not going to move, and most people are now again projecting or basing their expectations of a Fed move as far as interest rates in the first quarter of 2016. Don't be surprised if they actually move in December. And if that happens and they catch markets off guard, that could be enough to saber rattle markets and truly cause for a panic-like move the last few weeks to lower levels. Again, I'm not insinuating predicting it's going to happen, but it's a possibility. So just bear that in mind. But for now, markets are okay. But again, it's a very fragile state out there. There's not much conviction either way. Until that conviction is proven by commitment of paying essentially higher prices, you have to remain very cautious. Blog posts will be forthcoming. I will let you know when they're up and ready. And other than that, I want to thank you for taking time to watch the video. Trade safe, be careful, respect price for what it is. Do not trust markets. But again, follow price and see what markets are telling you. Talk to you next week.